Hold up.
Hey guys, so today we gonna go full Sherlock Holmes and uncover one of the most malevolent and nefarious activities by which market makers used to bring down the GameStop price. I said this last week, but I must cringe at myself and say it again, because this time it's more true than ever before. This is by far the most important video you will watch regarding GameStop if you wish to understand how market makers are manipulating the price. At the end of the video, you can let me know if you agree as well. If you have been puzzled as to how GameStop could drop so much in so little time, you are in the right place. Today we are going to wind the clocks back in time, and we are going to time travel decades back, to the moment where this insidious technique was born and implemented, and its role in destroying fair market value, retail investor value and investor trust. The fraud of choice that we will be exploring today goes by the name of seller boxing, and it dates back all the way to the late 90s. Seller boxing is a complex and sophisticated financial strategy designed to push a company's stock price to its lowest possible level, sometimes just fractions of a penny. Picture the stock price as a ladder leaning against a building. Seller boxing is like removing that ladder, causing the price to drop into the cellar, the legally permissible lowest trading level. It involves complex tactics and raises important concerns about market integrity and regulatory gaps. If you want to really learn, either for the first time or if you are in deep need of a strong detailed grasp of how exactly market makers are operating their GameStop operations, you need to pay close attention to this video. Nobody will explain it this deep, and you must watch the entirety of it as well to fully capture the corruption by which you are a victim of. Before we start talking about this, I need you guys to please do me a solid, if not for GameStop, for the sake of just bringing as much awareness of this to others. Please help me boost the outreach of this video by liking it and dropping a comment below, and if you haven't already. Also, there's no better place to be than my Discord. We talk about these things all time, while providing tons of free market education, day trading alerts, strong and growing trading and investing communities and much more. So come join us, it's free and we have all types of content that you like. So, as you guys know, GameStop had that rally where the stock shot up $80, but also rapidly went down back below $20 today. This brought to me a lot of flashbacks back to 2021, where we were new this for the most part and learning along the way all the ways by which market makers were manipulating prices. Of course, if you guys didn't watch my last video, please do so. One of the key ways market makers defeat the price action that is not convenient to them is by employing tactics that allow all the buy orders to be channeled to OTC markets. This takes away from the buying pressure that would allow the price of a stock to hold key vital support levels and even bounce and push upwards. Think of this as a fierce stream of water running down a river during a storm. The bullish price action is moving in the direction of the water in the river, pushing against a strong human-made barrier. The human barrier is sustaining the water, but it's slowing being pushed back, on the precipice of breaking down in the water, or price action, running past it as it would naturally happen. Well, human ingenuity can be a great thing, and in anticipating this exact thing would happen, humans designed a special canal right next to the bridge, that allows the fierce water current to deviate its normal path and go into special dams, water systems and other mechanized and controlled networks that allow humans to kill off the pressure of the water and systematically route it back past that barrier but with no strength whatsoever. That's what happened last week, with tons of evidence being shown that pretty much almost all orders throughout the day were being taken off exchanges and being redirected into OTC markets. We know how the scheme works, we talked about it at length, but it is by far not the only far hedge funds, market makers and other financial forces defeat the price action. Please do your best to not get emotionally carried away by what I am about to discuss. Try to be as objective and apathetic to the information, and not reach desperate conclusions like the price of GameStop will then never rise to what it should be, because as I will explain in the last part of this essay, that is not true either. I want to give credit of the following information to Blurring from InvestorsHub.com, who broke it down all the way back in 2004. Yes, even all the way back 20 years, retail investors were already becoming aware of this scheme. So, there is a form of securities fraud known as naked short selling, which has obviously become extremely popular and controversial over the past couple of years. It is extremely lucrative for market makers that employ it. To understand it, we have to look back at the NASD and the SEC. The National Association of Securities Dealers, or NASD, was a self-regulatory organization of the securities industry and the predecessor to FINRA. When I talk about the NASD, keep in mind I am talking about FINRA. Both these organizations arbitrarily set minimum levels by which stocks trade at. Some stocks can trade at 1/100th of a penny, and it's important to remember this. This 1/100th of a penny, which implies 3 zeros following the decimal and then a 1 as the fourth digit, can be used as a way to backstop a price if market makers decide to do it. This is where seller boxing comes in. Seller boxing was introduced in 1999. Prior to that year, the minimum that a market spread for most stocks was allowed to trade was about 1/8 of a dollar, and market makers were pretty much guaranteed a healthy spread. Since then, however, market makers have been able to change those 1/8 of a dollar spread to only a penny, as you can see in most normal stock quotes. Given that the normal typical spread is something that market makers derive a lot of profit on, they instead opted to use over-the-counter markets, like the OTC, where regulations tend to be a lot more relaxed or even non-existent in many aspects. In seller boxing, there's this thing called the seller level, which acts like a starting point. Anything gained above this level equals a 100% spread for market makers dealing with these stocks. To put it in perspective, the spread in established stocks like Microsoft is tiny, around 0.4%. But when the market hits a no bid to $0.0001 offer, the potential spread theoretically skyrockets to infinity. So, how do market makers get into seller boxing? Well, first, they need to drive the share price way down to these seller depths. The lower they push it, the bigger the percentage spreads they can take advantage of. This usually involves naked short selling, a tactic where MMs sell shares they don't actually have. If a market maker is big enough and has enough insight into buy and sell orders, they can pull off a slick maneuver. With one hand, they flood the market with fake shares, while with the other, they short sell into every buy order that pops up. This dual tactic kills off any demand for the real shares, pushing the prices down further. Ultimately, it creates a situation where there's no demand for shares but plenty of supply, leading to a downward spiral in prices. It gets even crazier than that. Check this out, fellas. Because there are no better and tougher versions of regulations implemented in OTC markets, US market makers have been legally doing naked short sales from Canada and other places, even though everyone involved knows these shares won't ever be delivered. How does this happen? Well, they have found some clever loopholes. NSCC's rules allow market makers to borrow shares from investors who keep them in, street name, at their brokerage firm. That's about 95% of us. The idea behind this borrowing was to allow trades to settle with a 1 or 2 day delay, but it turned into a major conflict of interest. Would investors knowingly loan their shares to those trying to bankrupt their investment if they knew it was helping naked short sellers? And should the investors' brokers, who are paid for these loans without the investors knowing, be involved in this process? Another weird thing happens at these seller levels. Back in the day, as this rule has been suspended by FINRA Rule 11860, NASDAQ Rule 3370 would allow market makers legally sell non-existent shares into markets where there are lots of buy orders but few sell orders. This is still allowed, by the way, but through other rules now. This means a market maker could sit at the 1/100th of a penny level all day, selling fake shares because there's a huge difference between buy and sell orders. Every time the share price tries to rise from this seller floor, someone is there to push it back down. Once a micro-cap corporation is stuck in this seller, it doesn't have many options to get out. One way might be to do a reverse split, but history shows this usually doesn't work well. It often just drives down the market value again. But the better version by which market makers are now employing their fraud and abuse is a lot easier to understand. Check this out. Market makers rally shareholders for a sustained buying effort to break out of the seller. But usually, there's magically a naked short sell order to meet every buy order. Sometimes, shareholders can push the market to $0.0001 bid and $0.0002 offer briefly. But then market makers flood the $0.0001 bids with selling, driving the market back to no bid and $0.0001 offer. After seeing this a few times, weak-kneed shareholders often decide to sell their shares the next time a $0.0001 bid appears and get out fast. This is called shaking the tree for nervous investors, and it works well. Sometimes, the market hits $0.0001 bid and $0.0003 offer, creating a big 200% spread for market makers, which scares off buyers from reaching the lofty level of $0.0003. If a $0.0002 bid pops up from a market maker not playing ball with the unscrupulous ones, it gets hit so fast that level 2 doesn't even show it. The $0.0001 bid at $0.0003 offer sets up a stalemate where market makers enjoy big spreads while the victim company slowly dilutes itself to death by selling real shares at super low prices to pay monthly bills. Since these companies have to pay monthly bills, time favors the naked short sellers. Sometimes it seems like the unscrupulous market makers aren't trying to kill the victim company outright but rather want to milk the situation as long as possible, letting the corporation die slowly by dilution. It's easy to strip away 99% of a victim company's share price and keep it boxed in the cellar, but it's hard to kill a corporation, especially after management and shareholders figure out the game is being played at their expense. Now you know where the term cellar boxing comes from though. As time passes, and this is going to happen with GME and AMC now for sure, so pay attention, market makers will rake in huge profits with these large percentage spreads, but the total naked short positions skyrocket due to all this activity. This is good for shareholders and people that consistently buy and hold. This also makes some of the colluding market makers nervous. They're in a bind because they can't stop naked short selling into every buy order, or else the share price will shoot up, putting immense pressure on their capital reserves and margin requirements. Plus, covering the naked short position isn't an option since they can't even halt the day-to-day naked short selling. What usually occurs in these scenarios is that the victim company has to significantly dilute its share structure by constantly selling real shares at artificially low prices to cover its monthly expenses. Then, the aim of the naked short sellers is to convince investors, often through paid internet bashers, that with, let's say, 50 billion shares outstanding, the company isn't worth the $5 million market cap it's trading at, especially if it's just a shell company whose main business plan was sabotaged by the naked short sellers earlier. The truth is that the most significant asset of these victim companies often becomes the astronomically large aggregate naked short position accumulated during the initial bear raid and the seller boxing phase. Now, the goal for the victim company is to avoid the three main objectives of the naked short sellers: bankruptcy, a reverse split, or the forced signing of a death spiral convertible debenture out of desperation. As long as the victim company can keep up with its monthly expenses, the strategy shifts to making strategic moves, like name changes, CUSIP number changes, cancel or reissue procedures, dividend distributions, and amending bylaws and articles of corporation. Nevada-based companies typically cancel all shares, both real and fake, and require shareholders and their brokers, dealers to prove ownership of old real shares before issuing new ones. Many also file civil suits during this time. This indirect coercion of hundreds of U.S. microcap corporations to navigate these hurdles to survive, due to either regulatory indifference or resource limitations, is perhaps one of the biggest stains on the U.S. financial systems. In an ideal world, regulators would periodically audit the sub-accounts at the DTCC, as well as the proprietary accounts of market makers, clearing firms, and Canadian broker-dealers, and compel the purchase of counterfeit shares, many of which hide behind altered numbers, exceeding rule guidelines for allowable failed deliveries of 0.5% of issued shares. So this was a lot to take in, but now that the foundational part is down, let's rewind back and break it down in much easier terms. Naked short selling is a type of securities fraud that has been paramount for market makers to be able to make money. The term seller boxing refers to a specific investment strategy that involves reducing a stock to its seller level, which is the minimum level at which a stock can trade as defined by the SEC and FINRA. However, the funny thing about seller levels is that they don't exist in OTC markets. There is an infinite spread at some points in the market where there are no bids. Market makers must first bring stocks to prices like 1/100th of a penny to participate in seller boxing, which is why they must lower the share price via OTC markets first. The more they bring it down, the more percentage spreads they exploit to help cover their behinds. How does seller boxing work? It works in 3 steps, as previously discussed by now will be summarized. The first step is aggressive short selling. This legal practice involves borrowing shares, selling them short, and repurchasing them later at a lower price to pocket the difference. However, excessive short selling, particularly involving large institutions, can create downward pressure on the stock price. The second step is naked short selling. This illegal practice involves selling borrowed shares without ever owning them, essentially creating synthetic shares and flooding the market with phantom supply. While its existence is debated, accusations of its use in seller boxing raise concerns about market integrity. Lastly, The third step, as I understand it, is through the bid and ask manipulation. Manipulators, in this case market makers, may attempt to control the buy and sell orders, otherwise known as the bid and ask, for the targeted stock. Setting artificially low buy prices and high sell prices discourages potential buyers, further isolating the stock and pushing the price downwards. So why are hedge funds and market makers all involved in seller boxing in regards to GameStop? Easy, because of GameStop's growing potential for short squeezes and volatility. By accumulating very large short positions, manipulators might aim to profit from a short squeeze, where the price rebounds sharply due to limited available shares. This creates significant volatility and exposes other investors to substantial risks. This money is then used to try to cover their positions as much as possible, as to keep everything below the radar of regulators, who probably already know what's happening but can act blind until things fizzle out of control. However, this isn't the only reason they do seller boxing. They use this technique and method to buy cheap assets like GameStop themselves. The suppressed price of GameStop could allow manipulators to acquire undervalued assets cheaply during a potential bankruptcy auction. This raises questions about potential insider information and exploitation of struggling companies. More importantly, the biggest reason for seller boxing is to drive the stock down and force them to delist, eliminating them from the market altogether and potentially have them fully trade on OTC markets, where they will run rounds and rounds. The effects of seller boxing are brutal for shareholders. Investors take huge losses and sit on red for very long periods of time, which results in eroded trust in the market system, in the company itself, and in investing altogether, which is the best way to grow people's net worth over time along with real estate. The effects aren't exclusive to retail investors though. The damage to the company cannot be understated, and the market distortion can create huge distrust that could result in the polarization of politics, which discourages long-term investments and damages the ultimate health of the markets itself. So how do we stay ahead? How do we win this game? It's hard to think about GameStop at times and not worry about your investment. This is why I always encourage people to have safe assets in their portfolios as well. The first and most important way to stay strong and ahead of everything is to stay informed and remain skeptical of everything in the market. This does not mean always jumping to random conclusions. We have seen the depths of damage jumping to conclusion always results in, especially with so many YouTubers and social media gurus pumping specific prices for the stock to drive an engagement. You have to remain zen and realize the price of these assets are impossible to predict, especially GameStop more than anything else. You have to do a little bit of homework, reading market news, regulatory developments, corporate releases, and everything else in between. With that, you will have full awareness of what is happening and what the prospect of your money is looking like. Therefore, with that information, you can fashion a strong long-term strategy. I devise mine by limiting my GameStop position to be only a specified amount of my overall portfolio. It allows me to balance it, counteracting the downward price action driven by hedge funds by having my stronger blue chips, tech and other investments outperform that loss, and with the help of dividends and option plays, allow me the ability to continue carefully adding to my position long-term. GameStop is, by comparison to all other investments, one of my smallest positions, because I am clear about the risks that befall it and also am aware of the insane levels of criminality by which the company and therefore investment is privy to. However, I do not sell, I only add in smart, concise positions as time passes by, because I am aware of the immense potential of this stock. Do I think GameStop has the ability to run up again? Absolutely. What happened last week wasn't because of the return of the Roaring Kitty, though he might have partially fueled the market rally on Monday. No, this run-up was weeks in the making, and just like it happened then and on many other occasions, it is likely to happen again. That is why I am waiting for the price to fall further before buying, because I want to average as much as possible but at very low levels. Just because market makers need to rely on seller boxing and channeling orders to the OTC markets does not take away from the GameStop short thesis. In fact, it proves it. Let them chip away at the stock. We are powerless to stop it in the short term, but hopefully, as people continue to accumulate and the stock becomes more volatile over time, one day we will be able to prove to the world through real evidence that the float has been locked away many times over, and that shorts need to close and that markets need total restructuring, along with a new-fashioned regulatory body that is more protective and engaged with what is happening. Fellas, let me know what you think of the video in the comments. Do let me know please if you made it to this very end, and also what your current thoughts are. Was the video clear? Did it make sense? Do you have a better understanding now of how the GameStop shorts are employing their methodology to destroy the price? These things matter to me. I try to be as concise as possible, but that can only work so much given the insane complexity of these financial systems. If you want to do me a favor, join my Discord and tag me in chat and let me know what you also thought there. If you haven't already, the invite link for the Discord will be in the pinned comment below. We have day trades, due diligence reports, long-term investing content, free educational content from books to video tutorials, and more importantly, a strong and growing community full of all investors and traders from all walks of life. This is all free and made available to you with the click of a simple invite link down below. With that said, I hope to see you guys on the next one. Have a great rest of your day and to the moon.